All right, welcome back to Survey of Accounting. A few announcements before I start, like always. Paul Menton Center, they're the place that helps students with accommodations, any accommodations that some students might need. They need a volunteer note taker. So for those of you who regularly attend class, and I do know that there are some people here that do, you might want to consider this. So these are the requirements of a volunteer note taker. All right. If you're interested, there's an email address here. All right. So, and I'll post this on WebCT as well. It says that expected that notes will be typed. I know it says typed up here. However, handwritten but very legible notes or notes containing math symbols or graphs can also be used. Okay. Volunteers who successfully complete the term will receive a letter of recognition from the Paul Menton Center. So there you go. It's your letter of recognition. You'll be assisting a fellow student meet their accommodation needs and facilitate their success in the course. You will also benefit by the commitment to take high-quality notes. Lastly, being a volunteer note-taker may prove to be a valuable addition to your resume. Okay, so consider that. So you can email them or just stop by room 501 of the University Center. Okay, so it's toward Tim Hortons. Just keep going on the other side. All right. All right, so if anybody's interested, please help out a fellow student. Okay. There's another announcement. The Educational, what is it called? Education Development Center, EDC, are always really interested in various topics on how students learn and how we can use technology for students and whatnot. And they are interested in laptop use in the classroom. So those people who've got laptops up, and I do see a few here, might be interested in that. There's a link for this questionnaire on my WebCT. So if you get into my WebCT, you'll see a link there right on the home page. Okay, so I've been asked to kindly let your students know about the survey, encourage them all to fill it out. The survey will be available to students until October the 8th, so that's a week from tomorrow at midnight. So you have roughly a week, 8 days to submit that. And it's rather interesting, you know. You bring your laptops. What a great tool. Is it helping you learn? You know, are you taking down notes or whatnot? I even told them I'd be interested in the results. So anyway, take that quiz or that survey. Anyway, see now results. Okay, so yesterday was Wednesday, September 29th. It was the due date for your first See Now quiz, and a lot of you did extraordinarily well. The average, I downloaded the results, was 94%. Way to go, you guys really understood the material. I am still bothered by a lot of people not actually having a See Now account or doing the quiz whatsoever. You might have gotten the account, but you didn't do it. These are relatively easy marks to get. Like you do get hints, not hints. You do get feedback after you've submitted it. You get to submit it 3 times. You do get to check your work. And they're not extraordinarily long either. They're fairly quick. My intent is that you just sit down and please do an accounting problem on the current week's work. All right. So please, and I'm probably speaking here to the converted. You've probably done it. If you're coming to class, you're engaged, you're making the effort. Fantastic. Did speak to a few people ahead of time, and I know that people did do it. A lot of people did do it here in the class. But yeah, please give it a try. This is 20% of your mark. All right. So 3 checks your works, 3 submissions of the online quiz. I mean, you get to work with other students to connect up, get to know your students, your fellow students here. I don't care. Just do some accounting, please. That's the intent here. And I do, you've got 9. I'm taking the best 8. So I just urge you all, get this easy 20%. Okay? Could mean the difference, between a wonderful A or not so good C, whatnot. So this is the quiz. I've just opened it up. It became available yesterday. I know some people have done it already and gotten perfect on it already, so fantastic. It's got its little quirks. I can see that. And I can tell you here on the bank rec question, if you haven't already attempted it, what it's going to ask you, first of all, it's asking for a bank rec. And it's giving you a nice schedule just to fill in the blanks by and large, so you can put in, well, what is the cash according to the bank statement? What it's looking for here in the first part are all the additions. In the second part, it's looking for the deductions. All right? So that's what's going on here. And it's got this funny subtotal thing here going on here. And again, here they're looking for some sort of addition that has to be made, and here some sort of deduction, that has to be made. So it's, like I say, it's a little bit quirky. And if you put deductions first and then additions, it'll say, sorry. And the other thing too, you've got two problems. Okay, so just get to the next problem. Just click on it there. All right. Yeah, it's got its little idiosyncrasies, right? So don't forget to put in no effect if there's no effect here on some of these accounts. All right. I guess that's about it. You can save your work at any time. Come back to it. I had a few email questions about that as well. Okay, so don't worry that, I don't have a big block of time to actually do the problems. Save your work. Come back to it. Okay, you can save without submitting, by the way. These are two distinct buttons. I don't know if you can tell that. But save is different than submit. All right, so I will submit to grading. I probably didn't do all that well. Anyway, and then if you want, you can get feedback on this too. So anyway, there's also, you'll notice what's become available, practice questions, and I've clearly indicated that there are no marks available for that. So if you're still keen, you want to do some more problems, just to make sure you understand the concept, go to the ones that say practice questions, no marks. And they will be putting in some more as time goes on, and making those available right away. All right. So in addition to the questions that we do in class, try some of these out. Just for extra practice, okay? Because what you're going to find is the more problems that you do, okay, the better you understand the concepts, okay? It'll just, solidify it. You'll feel a lot more confident when it comes to the midterm and the final, okay? And I know Dave isn't here, but past sessions continue, right? I think there was a room change, so check WebCT for that for one of the sessions, so check that out. And it's great extra practice, okay? And it's really the key. It really is the key. Okay. All right. Any questions on CNOW and online quizzes? Okay. All right. No news is good news. No questions? Good. All right. So what I'd like to do today is to cover two chapters, which I know sounds awful. Oh my goodness, that's a whole lot of work. But really what I want to do is just cover one really small topic in Chapter 5 and cover off Chapter 6. All right, so it's not as daunting as we think here. So the chapter devotes itself to other topics, which I won't be discussing. Sarbanes-Oxley, that is something unique to the States. Well, not unique. We've got equivalent sort of legislation, but it is an act that came out of some financial scandals in the States. I'm not going to touch that. Internal control, I'll just touch upon that briefly. Okay, but what I'm really concerned about in this chapter is cash. Right, so in particular, bank reconciliation. So you'll notice here I'm just covering two learning objectives. All right, so real quick chapter. All right, so we're going to just talk about the bank account and something called a bank reconciliation in controlling cash. All right, and I can tell you, all of my years of experience, this is so key, all right? I will not issue a set of financial statements until the bank recs are all done, okay? Until I know, and I've got some confidence that everything that's been deposited has somehow been recorded on the system, so I'm not missing out on revenue, all right? And I also want some confidence as well that all the expenses, all the checks that have been written have been recorded. And I get that assurance through my bank reconciliation, all right? It is like thing one that has to be done, my checklist of things, before I'll send out a set of financial statements to my internal users, all right? And I do this on a monthly basis. It's got to be done, all right? So what's neat about a bank account is that, as we've seen, businesses keep track of all the activity, right? So we've been using this long columnar sort of schedule, right? And this is just to denote that, we've got the accounting equation and that we've got certain accounts here, like cash, like accounts receivable on the one end, like accounts payable over here. But that we are always recording all the ins and the outs here on the cash. Okay? So businesses have records that report all the ins and the outs. Okay, so cash comes in, or we pay some expenses, or we get some money for some shares, or we have to pay off our loan or an account payable or whatnot. So we have this record keeping showing what's going on, what is all the activity in cash. The other thing that's going on is we've got a bank statement out there. And those of you most of you, I hope, have a bank account. And you either get a statement or you get a little passbook, okay? Or you might go online, right, and see all the activity. And really, we hope that the activity here in the books that businesses maintain mirror that activity on the bank statement. Okay? And that's what's going on. We've got the ins and outs here. And then our bank sends us a statement, usually every month, okay, or you get your passbook updated. And it also will show all the pluses and minuses and give you some sort of idea as to what your balance is, okay? And what we like to do at the end of the month is to make sure, did we record all of our deposits correctly? Did we record all of the withdrawals correctly? Like what's going on here? Did I make a mistake? Did I count for it all? Okay, so it's a really good internal control is what we call it, to ensure that we haven't made an error, okay, either in recording a plus or a minus, and that we've got complete records, okay, that we've recorded every check correctly. Okay, so when we make a deposit in business, we record this in our cash account, but the bank also records it. Okay? We write a check. We record it here, and when it gets cleared by the bank, and what that means is the person you've written the check to presents it for deposit into their account, that it gets eventually will get recorded as a subtraction here. Okay, they call it a debit on the bank statement. Okay. So at the end of the month, if we can just go through the list and see, did everything go through the account as what we thought? Okay, so if I made a deposit for $100, is there a corresponding $100 deposit over here? Okay, so generally what I do just line them up, and then I check them off. Yep. There was a $100 deposit that was recorded correctly into the bank statement. Right? Or I wrote a check for $50. Was there also a corresponding subtraction here, $50 on the bank statement? Okay. Now sometimes it happens, you write a check, let's say I write a check here for $75. I record it into my set of accounts here, my books. And when I go to the bank statement, there's no $75 deduction. Okay? I submitted that check or mailed it off to my supplier, and it has to take a few days to get there in the mail. All right? And then that supplier gets it, and then they have to go to the bank and present it for deposit, and then the bank has to clear it. Okay? And this can take at least a few days. Okay? And so sometimes I've written a check that's not recorded here. And we call that an outstanding check, okay, just that hasn't cleared. Or I may make a deposit, and oddly enough, today is September 30th. Okay. I might make a deposit of $120, and by the time I get it to the bank, they're closed. Okay, so they're going to record it on next month's statement. Okay, so when I go to do my bank reconciliation, looking at this deposit, it's on the last day of the month. I look at my bank statement, it's not there. Okay, we call that a deposit in transit. Okay. We call this one an outstanding check. Okay. So when I'm doing this reconciliation, okay, I want to make sure that the balance on the bank statement, okay, let's say it's at $1,000, can be reconciled to the balance in the cash account here. I don't know. I'll just invent a number, 800. Okay. There will be differences, and the reason why there's differences is because of these outstanding items. Okay. Or it could be that the bank has charged service charges. Oh, they're really good at that. Always inventing new ones. You've got to love the bank for that. All right. So go to an ATM that's not your own. What do you get charged? It's not your own bank. $1.50. Drag. That's your money, by the way. Anyway, so you might not be aware of that. You might not have recorded that service charge in your cash account. Okay, so what's another thing that might be here? Sometimes banks will collect notes on our behalf. I don't know, maybe a $1,000 note. And we don't know about it for whatever reason. All right. Right, so it's not recorded here on the cash records. Okay, so a lot of reconciling items going on here. And that's what we hope to do with our bank reconciliation. Right? So what this slide is just showing us is that there's this mirror image, we hope, as we make deposits, generally it's deposits, and we record them in the company's books, okay, that they'll be mirrored on the bank statement, okay, either as interest earned, loan proceeds, notes receivable, collections, okay, other credit memoranda, okay, deposits, and that as we write checks, okay, that they'll be recorded on the bank as well, okay, decreases. Right, so, go to my next slide. We can reconcile the balance on the bank statement, okay, to the balance in our records. Okay, we call it bank reconciliation. Right? And so, similar to what I've just shown you here, some of the more common reconciling items is that I've got a deposit in transit, didn't make the bank statement. I wrote a check, it didn't clear yet, call that an outstanding check. Or in this end of things, the bank collected a note, we didn't record it. The bank charged us a service fee, and we didn't record it. Okay, so if we want the balances to agree, we prepare a bank statement reconciliation. And this is the format that it takes. So we're going to start with the balance according to the bank. Okay, so this is from your bank statement. And we'll say that's all good. However, we know that's not the true balance. Okay? We know that maybe there was a deposit in transit, as I mentioned here. We recorded a deposit we were going to make on September the 30th. Whenever we get to the bank, they're closed. Maybe we put it into the night depository, okay, or we put it into the ATM, but it doesn't get actually credited to our account until the next day. Okay. So that's going to be a reconciling item. Or maybe we wrote a check that hasn't been presented yet by our supplier to the bank. Okay, outstanding checks. All right, so generally record that next. All right, and then we come up with an adjusted balance. This is the true balance, actually. Okay, we might think that just by looking at our bank records that, okay, that's good enough. That's exactly what I've got in my bank. Okay, and then you're surprised to find out that, ooh, a check bounced. Only because that's not the true bank balance. Okay, if you've written a check that hasn't been presented for deposit by that person you wrote it out to, it's not going to show up in the bank statement. Okay? So it's not going to be reflected in this amount here. So that can't be your true balance. All right. All right, so the other part of the bank reconciliation is we take the bank balance according to the company's records. Okay? So the $800 in my made-up example here. And what we want to do is show anything that we haven't recorded that we can capture from the bank statement. So, it could be a collection of a note, could be a service charge. Okay? So there's the next line here. Notes collected by the bank or any other credit memos. The bank gives you interest. You might be lucky enough to have an account with interest. All right? And you didn't know how much that was. You haven't yet recorded it on your company's books. All right? So you'll add that here. Okay. And you might have some unrecorded decreases in cash. This happens less and less, I have to say, okay? Because I'm always checking my online anyway, any debit memos that have gone through, any service charges, okay, so that I know to record it on my accounting system. Okay, I want to be able to capture all that. There's another item here that I haven't talked about: NSF checks. Okay. You know what that means, by the way? Non-sufficient funds, okay? Not a good place to be. So, sufficient. I can't spell this morning. Funds. Okay, so that's where the NSF and F come from, non-sufficient funds. So, what you would do as a business, or even personally, is you get somebody's check, okay, and you think, great, I've got some money here. It's either to pay for a good or a service or whatever, and you go to deposit it. Okay, so you present it for deposit to your bank. Now, your bank, they're pretty trusting. They're going to actually give you a credit into your bank account. Okay, so when it's deposited, the bank will add that amount to your account. Now, what they have to do is actually clear it. There's a process of clearing. right? So you've deposited a check. It's on somebody else's bank account, right? So, so at the Canadian Horticultural Council, we got a check in yesterday. Actually, we got many checks in yesterday that have to be deposited. They're from various farmers, actually, from across Canada. And we're pretty trusting. We're pretty sure that they're good for the money. We're going to deposit those amounts today. Okay, so they're written on all sorts of bank accounts from all over Canada, various farmers. Okay, they've given us some money. And like I said, the bank is pretty trusting. They're going to add that amount to our bank account today. Right? Now, it goes through this process of clearing. Okay, so that customer has a bank account, and it will be deducted from that customer's bank account in probably a few days. Okay, it's got to clear through the accounts, so it's going to take some time. All right, so that takes, I don't know, 2 to 3 business days. They're always trying to speed this up. Okay, because if you could think, if you're the bank and you're giving somebody credit for an amount, you're going to want to make sure that you actually get the funds. Okay, truly get the funds within a quick amount of time. Yeah, this used to take many days, but they're really trying to close down the window here. And so that customer's bank account will be deducted by that amount within 2 to 3 business days. That's the process of clearing. Now, it could happen that whenever it goes through this clearing process, that there's not enough money in your customer's bank account. Okay, if you can imagine that. They've written a check, and there's not enough funds in their account to have it clear. Right? We say that'll bounce. We call that a bounce check. So what's going to happen is your bank will tell you, hey, there wasn't enough funds in that bank account. Okay? So we've added it to your account. Now we're going to have to deduct it. Okay? And they'll say the reason will be NSF check. That's what it will say as the reason, non-sufficient funds. Okay? So, you know, how can you... Oh, and they'll also charge you a lot of fees, too, by the way, right? A whole lot of extra fees. And so it's not a good place to be. You might not know about this until the end of the month, whenever you get your bank statement in. Okay? But I know generally now we go online. I know I do. I'm always going online. I'm checking all the credit memos, all the debit memos, what's going on in the bank account. All right? And so this isn't so much of a surprise, okay, these NSF checks. Okay? The bank will also mail back the check to you. They'll say, here, you can have it back. All right? And so then you can go and collect it again from your customer. Right? But if you didn't know about it and you haven't yet recorded it in your accounting system, this is the spot where you'll deduct it. Okay? So all these amounts will be deducted. And so we hope at the end of the day that the adjusted balance on this part of the reconciliation agrees to the adjusted balance on the bank statement part of the reconciliation. Right? And at this point, we can say, yeah, we're pretty confident that we've recorded everything, okay, that there is some notion here of completeness. We can't say for sure that we've recorded all the items, okay, and that we're sure that there's no errors in our accounting system. Okay, so bank reconciliation ensures that all of the entries that we've put through the cash account here are somewhat correct and complete. It gives us that little bit extra assurance. So if I'm going to now issue a set of financial statements, I'm pretty sure that I've probably, I'm not saying I'm absolutely certain, recorded all the revenue and expenses. Okay. All right, so that's what bank reconciliation does. Okay. So here are the steps in the reconciliation process, and really what this is going through the format. Okay, so it's enter the cash balance according to the bank, from the ending cash balance according to the bank statement. That's step 1. So if I just go back here, what they're saying is enter in this line. Okay, that's step number 1. All right, and then it's telling you add the deposits not recorded by the bank. Okay, going back here, that's step 2. What they're telling you is just follow the format, okay, that's been put out here. It's kind of like a template. Okay, if you want to prepare a bank statement reconciliation, go to this template. Deduct any outstanding checks. Okay, decreases in cash not on the bank statement. So the bank doesn't know about those checks that you wrote that haven't been presented yet. Okay, and then step number 4, say determine the adjusted balance. Okay. All right. And it just continues on like that in terms of the steps. And I just pulled this straight out of your textbook, but really what they're saying, Or these are the steps. Follow the format, and hopefully at the end of the day, your two adjusted balances will agree. Okay? Now, I do this actually personally because I do write a lot of checks, okay, on my checking account. And I do have a lot of pre-authorized payments going through my account. I've got a mortgage, okay, and I've got a car loan because I had to replace my car this past summer. All right. And I've got other payments that are coming out of my bank account. So I like to keep track of my bank account in a little thing called a check register. I know it's a very antiquated idea, but does anybody here do that? Have a check register. All right, less and less every year. When I first started teaching accounting, most people would put up their hands. Yes, I have a check register. But how do you know your bank balance or what's your true cash balance? Yeah, yeah. So a lot of you don't pay by check, right? So if you're going to go pay for whatever, your tuition or your cell phone bill or whatnot, you're going to pay by online transfer, right? Yeah? Oh. Can somebody turn my mic up there? I guess they can't be, people can't hear me? All right. All right, thanks a lot. I don't turn up my mic. Somebody does that mysteriously somewhere else. All right. Okay, so yeah, so most people will take a look at their bank statement, their cash according to their bank, okay, this amount right here, and say that's pretty much bang on because they do pay by online banking. Okay, they're going to pay their cell phone bill that way. They're going to pay for tuition or whatnot that way. Okay, just going in and transferring money from your bank account to somebody, actually to another bank account or to a bill payment. Okay, for those of us who do write checks, right, and I still do write checks. Just my kids' activities. That's how I pay for ringette, and that's how I pay for dance class. Is I write a check or a series of checks. I've got kids. Anyway, that's how we do it. And businesses, by and large, still pay a lot of things by check. Okay? They won't go in and do it electronically. And the reason why that is they want to keep control over disbursements. Okay? So if you can imagine, you give all that control to the accountant. Go in and take money out of the account at random, at will, and pay this bill, this bill, this bill. Okay? As a business owner, as a shareholder, whatnot, we do have a lot of confidence in the safety of that system. It can be abused, right? To give the accountant that much control over that much funds, right? So generally, what's nice about checks in business anyway is that we can have two people sign, all right? And it's just that extra check that, somebody's not going to go on a spending spree with the bank account, right? So we want that internal control, right? So that's why businesses write checks, and that's why bank statement reconciliations are really crucial. Okay. All right. So let's go through ones you actually understand what I've just been talking about. We'll go through a problem. This is from the textbook. It's problem P5-3. Right. So the cash account for Fred's Sports Company on June the 1st, 2010 indicated a balance of $16,515. What they're saying is this is, they've been keeping track on their accounting system of all the ins and outs, and this is the balance on June the 1st. Okay, so that's what they're saying. There's the balance. Okay. During June, the total cash deposited was $40,150. Checks written totaled $43,600. All right. So I just try to understand this. That was the balance June the 1st. During the June, all of this happened. So if I wanted to know what is the balance now at the end of June, I think what I'm going to have to do is start with 16,515. I'll add the cash deposited and the checks written. All right. It's funny how it doesn't always appear the way I've written it. 43,600. I swear I wrote 43,600. All right. So how much money do I have left? Okay. So I don't have room over there. But I'm figuring my new balance at the end of June is $13,065. Okay. The bank statement indicated a balance of $18,175 on June the 30th. So clearly, we're not in agreement here. Okay. The accounting records are saying one thing, the bank is saying another. Okay. So something's going on here. So somebody compared the bank statement to all the activity in the bank account for that month. Okay, that's the process of preparing the bank reconciliation. And they revealed the following reconciling items, meaning something was recorded on one end, but not cleared through the other side of things. So either something's recorded on the bank statement, we don't see a corresponding entry on the accounting records, or something's recorded on the accounting records, we don't see a corresponding entry on the bank statement. All right. Checks outstanding totaled $6,840. So these are all the reconciling items. Okay. There's an error, all sorts of things going on. We are asked to prepare a bank reconciliation as of June the 30th. Okay. And illustrate the effects on the accounts and financial statements of the bank reconciliation. Okay. So we know that if we're asked to prepare a bank reconciliation, we should really go to that nice format. Okay. So I'm going to go back there. Okay. There's something to remember from this. It's just that format. What's nice is that CNow as well has just put this sort of format into the quiz this week. Okay. We're going to add any deposits in transit or any of these credit memorandum that are not recorded on the accounting records in the on the bank statement. Okay. All right. And the other thing too, I want to make sure I've got enough room. I'll just start the bank statement section of it here. And then I think on another page, I'm going to start the accounting records. So cash balance according to the company. Okay, so this is from their accounting records. And what we generally do is add any notes collected by the bank or any unrecorded credit memos. Right? So 2 sections. And all I have to do now is to sort of start filling in the blanks here of my bank rec. Okay, so we'll get back to that. So let's just start one little bit of information at a time. We've calculated the bank balance according to the accounting records. It's $13,065. That's not on the first section, because this is all the cash balance according to the bank and onward. Be on the second section here. $13,065. Cash balance according to the company. Okay, so filling in that part. So we've got that piece of information. The next piece of information says that the bank statement indicated a balance of $18,175. Okay, so that's on my first section. So I go back here. The cash balance according to the bank, $18,175. Okay. Just going to take it one piece of information, put it into the format, okay, of the bank reconciliation. So next sentence says comparing the bank statement. Here are the following reconciling items. First up, A, checks outstanding totaled $6,840. Anybody remember what part of the bank rec does it go under? Does it go under any adjustment here in the first section according to the bank, or does it go as an adjustment to the balance according to the books of the business? Anybody remember? Outstanding checks. Yes? Right. Pardon me? Right there. Yeah, it was the next line. I didn't record them all. Outstanding checks. You can tell this American textbook, eh? You spell checks with CK. Anyway, so outstanding, checks outstanding totaled that. So that is something that I'm going to subtract, right? $68.40. A deposit of $4,275 representing receipts of June 30th had been made too late to appear on the bank statement. Okay? So they got to the bank too late. Do I record it here as an adjustment to the balance according to the bank, or an adjustment to the balance according to the company? Cynthia? Which section? To the bank, right? Because it's a deposit in transit. Okay, that's exactly it. Somebody just didn't get to the bank. It was in transit at the time. So we're going to add $42.75. Okay. All right, so doing well. We're just taking each piece of information, putting it into the format. This is an interesting one, and I didn't cover it, but let's think it through. A check for $640 had been incorrectly charged by the bank as $460. So, if I'm to understand this correctly, the bank made a mistake. You wrote a check for $640, okay, the business, Fred Sports, but the bank incorrectly charged it on your bank account, on your bank statement. They only deducted $460. Okay? So they've made an error. Yes? It doesn't flow into any of the financial statements. It's just something we do to get extra assurance that things are complete and there's no errors on the statements. Okay? So it's going to figure out for us, did the bank make any mistakes? Did we make any mistakes recording revenue or expenses? And are they somewhat complete? We get just that bit of extra assurance. Okay, so the bank has made a mistake. Right? They haven't deducted an amount, not enough of an amount, from our bank account. Okay? They've recorded a check that was written as $640, but only deducted $460 from our account. Where are we going to make that adjustment? On the bank statement side of the reconciliation or on the accounting side of the company? The bank rec, yeah. So what this means is that they've got to record something, okay, that is error. Recording check. All right. So they had deducted $460, but it should have been recorded as a deduction of $640. What effect does that have here? Do I add this to the balance according to the bank, or do I subtract it? Deduct 180, right? Because the difference is 180, and they haven't deducted enough. Okay, so what we're saying here is, well, they should deduct $180 more. We want our company's books to be in sync with the bank statement. Okay, the bank made a mistake. They didn't deduct enough, so we should deduct $180 from the balance according to the bank statement. Okay? And I can actually say, I've been looking at bank reconciliations for a very, very long time. All right? And the bank rarely makes mistakes, by the way. I don't know why. They've got some sort of system in place that it's rare that this would happen. But it always comes up in textbooks. But just so you know, this rarely happens in the real world. Okay? What more often happens is that the accountant has made a mistake recording the check, okay, or the bookkeeper has. All right. So the next piece of information, a check for $80 returned with the statement had been recorded by Fred Sports Company as $800. The check was for payment of an obligation to Maliski Company on account. So this is where somebody at Fred Sports Company, the accountant, the bookkeeper, whatnot, recorded it wrong, right? Because it was actually, in fact, $80. Okay, so they recorded it as $800. It's really $80. Where do we show that adjustment? On the bank statement side of the bank rec? On the accounting side. There's something wrong with the books here, okay, the balance according to the company. So they've deducted way too much, right? It was a check they showed as a deduction of $800. And it should have been $80 only. What do we have to do to our bank account? Add to it or subtract from it? Add to it, yeah. Yeah, because the difference here is $720, right? Right. Okay. So if we've deducted too much, we should add back the difference. Okay, so that's D. All right, so what else are we presented with here as a reconciling item? E. The bank had collected for Fred Sports Company $3,240 on a note left for collection. The face of the note was $3,000. Okay, so I think this used to happen a lot more often in the past. Generally, I don't see banks do this a lot, but some companies do this. They'll collect a note for you. Collection companies will do this. Right? But in this case, you told the bank, hey, this person owes me money. You go and collect it, put it into my bank account. Okay? So that's what they've done. They've collected the note. The face of the note was $3,000. They got $3,240. Can only assume that a portion here is interest. Okay? They collected the note with interest for you. Right? So it sounds like, if the bank knows about it, It's probably already been recorded and reflected here on the bank statement, okay, that this balance, but that you haven't recorded it here. Okay. So I'm going to add 3,240 here. Okay. The interest. Yeah, they collected the note, it seems, with interest. So they collected 3,240, and they put it into the bank account of the sports company. Yeah, it's recorded in the company's books as a $3,000 note receivable. Okay, they've collected it for us. Whenever we get the next part of this problem is we'll show how this has to be recorded in the accounting of the company. So we'll show that the note's been received, but that also we've gotten some interest. Okay? Yeah. All right. Yeah, so just as an aside, banks don't generally do this all that often, but I know companies do. I had coffee with a friend last week, and she works for a company that does exactly this. She collects people's receivables, right? So they discount it, though. They say, your receivable is $3,000. Here, we'll give you today. Anyway, a little bit less. All right, so we've done that. Bank service charges for June amounted to $35. Where do I record that? In the books, the accounting records, or on the bank statement side of the reconciliation? Bank statement? Does the bank know about the service charge? Probably. Do we know about it? That Jason Sports whatever? Probably not. Okay, so we're going to deduct here the service charge. Only $35. Wow, it's a deal. Banks are getting very creative in creating service charges. All right. So we're going to record that as an adjustment here to our accounting books. Okay. We didn't know about it, or it sounds like we didn't know about it because we're showing it here as an reconciling item. A check for $1,560 from Chimtech Company was returned by the bank because of insufficient funds. All right. So as I explained earlier, sometimes you prepare your bank deposit. Let me just bring this one back. The bank will add that amount to your account. Okay, you present a check for deposit. They're going to say, yeah, we're pretty sure that that money is good. By the time it clears your customer's bank account, all right, it'll be deducted. If there's not enough funds there, it bounces back. Okay, they call it a rubber check. All right, bounces back. They'll tell about your bank, and your bank will then deduct it from your account. Right. So, most likely, it's already been recorded when calculating this balance of $18,175 on your bank statement, but you don't know about it. Okay. So you've got to show it now as an adjustment on your balance according to the company's books. I think that's it. We are done with the reconciling items. Well, I hope this works, because at the end of the day, what's supposed to happen is our adjusted balance, according to the books of the company, should equal the adjusted balance on the other side of the reconciliation. Anyway, let's see. So I get 15,430. All right, so I'll do the same on the other side of the bank reconciliation. So I'm now going to the bank statement side of things. Whew. Well, that's good. It'd be really embarrassing if I didn't get that agreeing. All right. So my two adjusted balances agree. Okay. I started with the bank statement, okay, and I looked at the ending balance there, and I said, you know what, that's not my true bank balance. Okay. There's a deposit that's not recorded in there. Okay. There are some checks that have still not cleared. Right. I've mailed them off for whatever reason. My suppliers haven't cashed them. All right. So until they do, I don't want to actually count that money as my own. The bank made a mistake. Right. So my true bank balance here is $15,430. Same thing with the other side here of the reconciliation. I looked at my accounting records. I've been keeping some nice tabs going on there and some columns. And I realized that, oh, I guess I didn't record this elsewhere, that there was an error in one of the checks that I've recorded. The note was collected by the bank, and that there are some things I didn't know about, some service charges and an NSF check. Okay? So at the end of the day, this is my true bank balance, okay? $15,430. And this also serves another purpose, too. If I'm doing a cash budget, which I'm always doing in each of my jobs, okay, as a controller and manager of finance, is I want to know what is my true bank balance. Okay, so I go into work. Yesterday was my day for the Horticultural Council. I go in and what am I doing? I'm checking online to see if there's anything on the bank statement, on the bank records that I haven't posted yet, that I don't know about. Okay, and that things are being deducted as they should be. And I'm coming up with a true bank balance, and then I'm forecasting cash. One of the things I do quite often with each of the companies that I work for. I'm looking at, well, what do I have to pay in the future? And what are my accounts receivable like? Am I going to be getting any cash in? All right? So that we can meet our obligations, pay payroll. Right? It's very important. But a bank rec helps me do that. I come up with an adjusted balance. I know what it truly is. Because I can't seem to trust the accounting records. And I can't seem to trust what the bank is telling me is my balance. Okay? Not one of them is absolutely correct. So it's really important to have a correct number there. Any questions on bank rec? Okay, because there is one in the CNOW assignment that opened up yesterday. Okay, so follow the format. And CNOW is pretty finicky too. They actually want it in this format. Okay, so they'll actually, this is already written into the CNOW assignment. It says cash balance according to bank, and all you have to do is enter the amount in. But then you're given blanks, okay, after that. It will be looking for additions, then subtractions, then come up with, your adjusted balance. Right? It's very similar to CNOW. And that's the end of Chapter 5. That's all I wanted to say about Chapter 5. Doesn't mean we're done, though. No, we are not done. Let me back my cursor. No. I want to start Chapter 6. All right. So Chapter 6 is a bit of a hodgepodge. We're going to start to cover some of the balance sheet amounts in more detail. Okay. So we're looking at specifically receivables and inventory. Up until now, the only thing I've said about receivables and inventory is to give you an indication as to what they mean. Okay. And that's about it. But let's go into what we actually have to do to come up with the amount. Okay, what has to be adjusted or contemplated before we look at our balance sheet and put some amounts there. Right. And for a lot of businesses, receivables and inventory are huge parts of their balance sheet. Okay. They have a lot of money tied up in receivables and inventory. Okay. So how do they record it on their balance sheet? It's critical importance. Okay. So we'll just look at common classifications of receivables. And then something we just haven't mentioned yet here, uncollected. Oh, I'm in the wrong spot here. There we go. Uncollectible receivables. Okay, so what is a receivable? Let's go back a little bit. I'm working for the Horticultural Council. We invoice membership fees, and I'm pretty trustworthy that my members will actually pay at the end of the day. But there is a chance that some of those amounts will be uncollectible. Okay. So how do I record that? And there is an accounting process for that. I hope that everybody pays, but I don't know if they all will. Yeah? Service business, any business that tells their customers, pay me later, okay, and issues an invoice. Okay? So any company that's got that sort of trust that their customers will eventually pay. All right? So then we've got different methods of recording uncollectible receivables, the direct write-off method, number 3, and something called the allowance method, number 4. Okay. And then we're going to spend the rest of the chapter looking at inventories. How do we actually record inventories? Right? So this is for merchandiser only. Okay? So companies that buy something and then resell merchandise. Now I just wanted to draw your attention to learning objective number 6. This is an American textbook, and they detail out 3 inventory cost flow assumptions. In Canada, we only have 2. Right? There's one in there that I won't be covering because it's no longer used in Canada for the last few years anyway. Okay? It's called LIFO. It's off the books. Okay? Hardly anybody was using it anyway. But if you see that part of your textbook and you're wondering, why didn't Patty cover that cost flow assumption? It's because we don't do it in Canada. So compare and contrast. Actually, we'll just be looking at 2 inventory costing methods, and then how are receivables inventory reported on the financial statements. Okay. So classifying receivables. We've got a number of ways that people can owe us money in business. All right. And by and large, the most popular one here is our customers. We extend credit to our customers. Okay. That's called accounts receivable. All right. So a lot of business done this way. Okay. So I know it's hard to believe, but you go to a business, you say, okay, could you, repair that window, or I have an electrician come in to put in a new circuit or whatnot. And they say, it's okay, don't have to pay me right away. Okay? They extend credit to their customers. Right? So that means is they give me an invoice later on. They say, it's okay, pay me later. There's a lot of risks involved, though, in that, isn't there? Okay? Instead of demanding cash right up front, COD. Okay, cash on delivery. You issue an invoice and you say, pay me later. What sort of, before we even get into the definition here, what do you think you should do as a business? Think critically about this. Before you tell your customers, okay, I'm going to provide a good or a service, I'm going to provide some accounting services to a company, what should I consider before even saying, I'll issue you an invoice? Do a credit check, right? Okay. So especially if the amount's going to be large, you say, I'm going to work for you and, I'm going to provide $5,000, $10,000 worth of service. Well, to me, that's a whole lot of money. Okay? And so I want to make sure that that customer of mine will actually pay. So I might do a credit check. What do you think's involved in a credit check, by the way? What do you think? Anybody ever filled in a credit application? It's not it's very same in the business world, business to business. No? What's on a credit application? What do you think they're checking? No? Do you pay your bills on time? So they might ask for credit references. So they might say, okay, Patty, who have you dealt with here that you've been a customer of, that, who have been some of your suppliers? Have you paid on time? And they'll actually phone them. And they'll say, okay, does the Horticultural Council really pay on time? Okay. Well, that's one way. Credit references. Okay. Oftentimes, there's information from your bank that's required there. They do phone your bank manager, and they say, does she bounce a lot of checks? Is there NSF checks? Let's hope not. But that's very similar personally. Okay, so you graduate someday, right? You finally get that job. You're not living like a poor student anymore. You go get a car, right? So you don't have enough money for the car. You need a loan. So somebody's going to check out your check credit, okay? And they're going to want to see, do you bounce checks? Okay. Do you have any credit references that can vouch the fact that you actually pay on time? Okay. But businesses do the same sort of thing. Okay. So they extend credit terms to their customers. They will check, especially if the amount is large. Okay. Like we deal with our hotels around the time of our annual general meeting. That bill is in excess of $150,000. You don't think that that hotel wants some assurance that we're going to pay for it? And they're going to do this years in advance, too. They'll say, okay, before we issue that invoice, will you pay? Right? But there is a chance, that some of your customers won't pay. Right? So, yeah. Then you've got to do a few things. We'll get to that. What's your recourse if you extend credit terms to your customers and they don't pay? Notes receivable, what this is referring to is promissory notes. Okay? So if you ever borrow money from the bank, you graduate and you get that car, the bank will have you sign a promissory note. And it's simply that. It's a note that says, I promise to pay the bank. Right? And it will show an amount, okay, and an interest rate, okay, and the date that you will pay them or how you will pay back. Okay. And then you sign it. All right, so you sign it. That is a note receivable. So it's not uncommon in business where, maybe you've got a problematic customer, they're not paying you, and you say, okay, how about you sign a note receivable, you pay me in installments with this amount of interest or whatnot. Or you might even, a business might lend money to another business. It's entirely possible. Or even lend money to directors and officers. Can happen. Right. Other receivables, interest receivable. So, you know, the Horticultural Council, we've got a bond portfolio, and we get interest from all these companies. Right, that comes with, you know, we've got bonds that come with interest. But the bonds only pay interest every 6 months. So in between, you know, here's my timeline. One date and another. So let's say they pay interest September 1st and March the 1st. I want to record the fact that in between here, they owe me interest. And I call that interest receivable. Could include taxes receivable. I don't really want to get into that in this course. And receivables from employees or officers. So hopefully they've written a note, a promissory note. Okay. Accounting for bad debts. All right. So let's say I've issued an invoice to my customer here. And who can I pick on? John. I'm issuing an invoice to John, and it's for accounting services rendered, $100, okay? And it says here at the bottom, pay within 30 days. Okay, these are my credit terms. Okay, so go over to John and I say, here's the invoice. Okay, you're going to have to pay me within 30 days. All right, pay up or else. There could be some problems here. I haven't done a credit check on John. Okay, I really don't know if he's good for the money. You are good for the money, right? Okay, good. All right. So, or he could just end up in bad straits. You know, business takes a downturn. There's a recession. Sales don't come in. He can't repay me the $100 for accounting services. All right. So, what can I do? What are some of these collection efforts, okay, that I can do to try to collect here from John? Anybody have any ideas? Yeah. What? Yeah, I can phone him up and say, hey, I know it's $100. I know business is bad. Can you pay in installments, you know, $20 installments over the next few months, next 5 months? What else can I do? Yeah, exactly. All right. Since I'm not really good at collections, and it's really the last thing I want to do, although I have done it, and I am doing it in one of my jobs here right now, I might sell this to a collection agency. So I go to the collection agency. John owes me money. He hasn't paid. Okay, but I really need this cash. I've got my own employees. I've got suppliers. I need cash, right? So the collection agency will say, fine. They'll take a look, they'll review the invoice, and they say, we'll pay you $80 for this $100 invoice. Well, okay. And then the collection agency will go and collect. I will assign this account receivable to the agency, and they will go collect, right? So that can happen. You know, do I really want to take that $20 deduction? I don't know. What else can I do? So we've sort of already alluded to the fact that we're phoning him, we're emailing him. After we got past the 30 days, all right, I'm going to start to harass him a little bit, all right. I can cut him off. Okay, that's the other thing that we can do. We can say, that's it. I'm not doing any more work for you, guy. Forget it, all right. You haven't paid this last invoice. You want me to do some more work for you? Pay this off first, okay. And the next time I sell to John, I might say, pay me in advance, all right, because you weren't so good at, you know, paying my invoice here. Right? That's another thing we can do. All right, so that's exactly what I'm doing for one of my jobs. I've got a huge account receivable balance. It's starting to affect the liquidity of the company. All right, so I'm emailing, I'm phoning, I'm giving them options as to pay. You want to pay by credit card? You want to pay by bank transfer? Come on, pay up. All right, and actually recently in one of them, so I was in that job on Tuesday. And there is a person who would like to do more business with the company, okay? And so the journals manager comes up and he says, they want to do more business. He's going to owe us another few $1,000s, but he hasn't paid the number of invoices. It's 2 or 3 invoices going back actually over a year. And so they said, well, we won't even consider doing work with him until he pays off the old stuff. So it's kind of like cutting off, all right? All right. I'm not going to do business with you anymore, right? But, so what might happen at the end of the day, regardless of our collection efforts, is we're not going to get any money, right? We call that bad debts. We've tried really, really hard, okay? We've, you know, done the credit check. We've hopefully we've screened them in advance, we've emailed them, we've, done all sorts of things. Nothing is happening. And we come to the conclusion that this isn't going to be paid, right? So we call that bad debts. How do we record bad debts? Well, we've got two options here. I can do the direct write-off method. Okay, so I come to the end of the day, John's declared bankruptcy, there's no money for any of the unsecured creditors like me, and so what I'll do is I can directly write it off. That's one of my options. So I'll just reduce accounts receivable, okay, and I'll record an expense, bad debt expense. That's the direct write-off method. Right? Now, that's allowable, although it's not adhering to the matching principle, because he might be declaring bankruptcy a year after I made the sale. And what the matching principle says is expenses have to be matched to the sale. Okay? That's all that the matching principle says. Expenses must be matched with the revenue. So if I made a sale in 2010, okay, I want to make sure I'm recording the expenses for all of those sales in 2010 in 2010. They've got to occur in the same time period. Right? So if I made that sale in 2010 to John, and he's not actually, we don't determine that he's uncollectible until 2011. If I do direct write-off in 2011, I'll actually be recording the expense in 2011 for revenue that occurred in 2010. Okay? So that's not adhering to the matching principle. So direct write-off can be done. Most likely you're going to violate this principle. You're going to have an expense pertaining to revenue recorded in the wrong period. Right? Not good. So what's more acceptable is something called the allowance method. Okay? You set up an allowance based on an estimate of your doubtful accounts. Okay? And you do that in the year of sale. Okay? Because you know that, okay, I'm extending a lot of credit terms to all sorts of people. And I know that at the end of the day, probably next year sometime, I'm going to come to the conclusion that they're not going to pay. I don't know how much, okay, exactly, but I will make an estimate. Okay? And it's okay in accounting to make an estimate. It's entirely fine. Right? So I've got two methods there. I can just take a percentage of my credit sales, or sometimes just even a percentage of sales, and I could age the accounts receivable. Okay? So let's take a look at these, just a little bit more detail. So the first method, direct write-off. Bad debt expense is recorded, and the receivable is written off whenever the account is determined to be worthless. Okay? A year later, I've tried everything. I've tried giving payment options to John here. I've tried, emailing and phoning and faxing, and he's telling me, I have no money, business is bad. He declares bankruptcy next year, and I'm like, oh, that's it. I'm definitely not getting anything. Okay, I'm an unsecured creditor, fall to the bottom of the list when it comes to bankruptcy proceedings. I am going to write it off now. So I reduce accounts receivable when I come to that conclusion, and I reduce retained earnings, my bad debt expense. Okay, it's going up here by $200. Right. Right. Under the allowance method, in the year of sale, I make an estimate. Okay, I've had so much sales this year, I've got an accounts receivable balance of whatever. I estimate that $30,000 will become uncollectible. So I want to record it in the year of sale. Okay. I'm going to create something, it's a special account, called the allowance for doubtful accounts. Okay. I'm not going to take it directly off accounts receivable, because I really don't know who exactly won't pay me. I'm just coming up with an estimate. I want to prepare an allowance. I want there to be a little cushion there of money I can write off against just on the balance sheet. And it is considered an asset account, but it's actually a special kind of asset account. It's a contra asset account, meaning it's going to be recorded against another asset account, contra asset against an asset account. Right? So I've created a special account just for this allowance, and I'm still going to show bad debt expense. Okay, retained earnings going down by $30,000. And so this is maintaining that whole matching principle. I want to abide by that. It's really important. Okay. So let me take a look here at this allowance for doubtful accounts. It's a special asset account. Okay. Generally, we have positive numbers as assets. This one's going to have, and it doesn't show here, a negative amount, okay, as the balance. Okay. So on the balance sheet, this is how it should look. Under assets, under current assets, remember I'm starting to classify my balance sheet here a little bit. I've got accounts receivable of $200,000, and from that I'm going to deduct my allowance for doubtful accounts. Okay. And then I'm going to show a net amount of $170,000. I just call that the net realizable value. Okay, it's a little bit less than what I thought. I'm making an allowance for this uncollectability. Don't know who exactly is going to not pay at the end of the day. I'm in discussions with a lot of my customers. I hope that they pay. But just in case they don't, I'm putting some money aside, just in case. Right? All right, so whenever a customer is identified as being uncollectible, definitely not going to get anything here, I will write off the account receivable. Here's the write-off, the account receivable, against the allowance for doubtful accounts. Okay? So remember, allowance for doubtful accounts generally has a negative balance. Okay? So if I increase it, the allowance for doubtful accounts, I'll actually be reducing it, right? And so I'm writing as each individual account becomes uncollectible. Okay, we've identified John will not pay. Okay? So I want to show that that account receivable will not be collected. And I've made an allowance for that last year. I'm going to write it off against that balance. Well, let's say John emerges from bankruptcy protection, okay, which is entirely possible, that you get restructured. That's what happens during bankruptcy protection. Right? So there's an act that comes into effect, and it says, okay, nobody can shut down business here. We're going to try to reorganize, maybe sell off some assets. We'll get some meetings of the creditors together. And the company actually stays in business afterwards. It's entirely possible. Okay? So John's reorganized. He's like, okay, I will pay you now. Okay? So if you've written off somebody and then they subsequently repay, what we're going to do is write off, reverse the write-off. Okay? That's number one. There's the entry. So I'm going to reinstate the account receivable. It's going to go back up by 1,000. The allowance for doubtful accounts, we won't need it, so we'll reverse that entry. And then we'll record the collection as we normally would. Cash goes up, accounts receivable goes down. So reverse the write-off and record the cash collection. All right. Oh, love it. See, I've got the wrong version of PowerPoint at home, so whenever I do this, and then I come here and you've got the nifty new PowerPoint, it's not showing up properly. Come on. No, no. This is what the slide should look like. Do you see that? So how do you estimate accounts receivable of uncollectible accounts? You just got to love this, eh? This is what the slide looks like, but when I put it through the slideshow presentation, I get something completely different. I'm going to use my past experience, okay? And I've got two methods here I can use. Percentage of credit sales or even percentage of sales. And I can age the accounts receivable. Okay. Let's see if this one. There. Okay. So this slide shows up better. That's good. So this one here, Newman Enterprises had credit sales of $1 million in 2010. Victor Newman gets together with his management, his accountants, and they say, well, based on last year's experience and the year before, usually about 1% of these sales never pay. Okay. So we'll just take 1% of credit sales and set up that as our allowance for doubtful accounts. Okay, so I will reduce my assets, okay, by, oh, geez. That's the wrong way. Now it works, all right. Allowance for doubtful accounts, that's going to have the effect of reducing assets by $10,000, and I'll record the expense, okay. This is how I set up an allowance, $10,000. The other option is to age my accounts receivable, okay. So it was interesting because one of my jobs the other day, I actually came up, I prepare my aging summary. I don't know if you can see that, and I've taken out the name of the company. This is a standard report that comes off the system, right? And what I've done too is I've deleted the names and just put in some made-up customer names here. But this is actually what my age summary looks like, right? So it shows the total that's owed by ABC Company, and where is it? Okay, is it current? Is it 31 to 60 days since the invoice date and I haven't received it? Is it 61 to 90 days since the invoice date and I haven't received it? Or are they 91 days plus? And unfortunately for me, a lot of the accounts at this company are 91 days plus. Right? So CDE company, they're current, so it's been less than 30 days since the invoice date. DEF company, they're current as well. Okay, but EFG company is not. They're 91 days plus. Right? So actually this report was a few pages long. Just so I've cut a lot of people out, and I took all the names out to protect the innocent here. So at the end of the day, let me just show you what I've got here. I've got total accounts receivable balance of this company is $122,503. A lot of it is current. Okay, that's the $78,000. Meaning, yeah, you are pretty current there, Patty. You're doing good. A lot, we got some in the 30 to 60, 61 to 90 days. Okay, but a whole portion of this, $39,319, is 91 days plus. Okay, and we can say that the likelihood that I'm actually going to collect some of this is quite low. Okay, if a customer has gotten to that late, okay, and they haven't paid, then the likelihood that I'll ever collect, I'm trying really hard, by the way. I'm emailing and faxing and phoning, and we're cutting people off, and there seems to be just a little bit of problem with the attention given to accounts receivable. But this is actually what a real customer age summary looks like. Okay? And so, like I say, I've taken things out to protect all the innocent and whatnot. So names of my customers and the name of the company has been taken out here. So you don't know which one. But that's what I'm trying to get across into this slide. This is an aging of accounts receivable. So you take a look, and this would be the totals at the end of the report. The total balance of my accounts receivable is $100,000. Now, most of that is current on my slide here. This is an ideal world where you keep all your customers current. All right. Some of it is 31 to 60 days. All right. And there should be a mechanism. As soon as everybody gets to 31 days, start phoning, start faxing. Some of the total account receivable balance has been 61 to 90 days since invoice date. Okay. And some of it's even over 90 days. So what I do with each one of these categories is I'll come up with an estimate. What is the likelihood that they'll never pay? Okay. And this is up to every company to come up with these percentages. Okay, the 0.5%, the 2%, the 10%, 50%. We see as the people get, their customers are longer and longer in paying or not paying in this case, the greater likelihood is that you won't get any money whatsoever. And what I'm doing is I'm just multiplying through. So I'll take that $80,000 of current account receivables, multiply by 1/2, because I'm saying, well, at the end of the day, probably $400 there won't be collected. Okay? For this category, 31 to 60 days, if I multiply through, I get $200, okay, and just so on. 5,000 times 10%, yeah, we've got about $500 there. That probably won't be collected here. Oh, these deadbeats, look at that. $2,500 most likely won't be collected. And I'll add them all up, and I'll say, okay, now that's what the allowance account should actually equal, $3,600. Okay. My next step, this is a little bit more involved. My next step is to compare the current balance in the allowance account to the required balance. I've gone through all of that wonderful calculation. I'm saying I should have $3,600 minus $3,600 balance in the allowance for doubtful accounts. I've only got $100 there. So my required entry should be $3,500 to bad debts. So I want to subtract $3,500 here from assets. So I'm going to increase my allowance for doubtful accounts by $3,500. And there's my bad debt expense, $3,500 on the other side. Okay. Any questions on any of these methods? No? All right, so there is a problem. This is a good time for a break. I've got about 10 to 10. All right, so we'll come back at 5 after 10 and do the problem. Okay? Enjoy your coffee. All right, welcome back. So, all had more coffee. All right, warming up. That's great. So I will finish up the chapter. And we had started looking at the allowance for doubtful accounts. Great. I've asked that you bring your conversations to a close. So, all right. So how do we get this amount into... I ask you to bring your conversations to a close. That's great. We were looking at how do we set up the allowance for doubtful accounts. There is a few options here. There's the percentage of sales, credit sales, or just plain sales. And it's simply a matter of taking that amount, putting it into the allowance account, or doing an aging analysis. Okay, so common report comes out of many accounting systems is an aging. How old are our accounts receivables? Since the date that we issued the invoice, how long has it been they haven't paid? Right? So we take a look at each of the categories, each of the time periods, multiply through by our estimate. It's just an estimate. Every company is going to be different here. Multiply through, that's what's been done here. And then total them all up to get what should the allowance for doubtful accounts be. Okay. In this case, it should be $3,600. And then somebody pointed out there is a typo here in my next slide, is that I'm taking a look at what the balance should be, comparing it to what the balance currently is. So what I'm going to do is subtract from it. So the balance should be minus 3,600, negative 3,600. I'll subtract from it what the balance currently is, which is negative 100. And that's where I get the required entry should be negative 3,500 minus 3,500. Okay, so we stopped here. So we're going to do a problem, setting up an allowance for doubtful accounts. Right? So this is P6-1, back of the chapter. We've got Wigs Plus Company supplies wigs and hair care products to beauty salons throughout California and the Pacific Northwest. The accounts receivable clerk for Wigs Plus prepared the following aging of receivable schedule. It is actually a standard schedule. I do it all the time. As of the end of business, December the 31st. Right? So similar to what we saw there from my anonymous company, we have a listing of customers. Okay? So Alpha Beauty, Blonde Wigs. How much do they owe us? And then let's classify that. Is it overdue or not? In this case, that $20,000 is not overdue, but this one, $11,000, is 31 to 60 days past due. Okay, so you give your customers some credit terms. Pay up within 30 days, please. These people are 31 to 60 days beyond that. So there's a break in the report. Like, they're not showing you everything here. There's this break. So we get to line 30. They're setting it up, I guess, as an Excel spreadsheet. And so we've got $925,550 in total accounts receivable that we can then divide up into, is it not past due? Is it 1 to 30 days past due? Okay, totals it all up for us. Okay. So they have a history. They've done an estimate here of what they think the percent uncollectible will be by age category. Okay, so Wigs Plus has a past history of uncollectible accounts by age category as follows. So this is what they think in their best experience they think they will not collect. Right? So as you get older, the receivables get older, the percentage uncollectible becomes larger. Right? So what we're going to do first, estimate the allowance for doubtful accounts based on the aging of receivable schedule. Okay? So let's go back. Got all these fancy percentages that we're going to multiply by the totals in the aging schedule. So not past due, 1 to 30, 31 to 60. Oh, so their accounting system is a little bit different, 120 days plus. Wow. Oh yeah, and every business is going to be a little bit different too. My husband used to work in a construction-related firm, and their receivables were awful. I mean, most likely you'd never get anybody paying within 30 days. You'd have everybody paying 30 to 60 days past due. Right? Some businesses, though, they keep a really close eye on this and can't not pay them. Try not paying your cell phone bill, by the way. What happens if you don't pay your cell phone bill? Anybody ever tried that? Get cut off, right? That's what I was talking about before. You won't sell to them again. Right? Cut off. Right? Try not paying a whole lot of things and see how far you can get. All right. So in some industries, everybody's, their accounts receivable is going to be quite current. Others, not so much. All right. So I'm going to take the totals in each one of these categories. So what do we have here? Not past due. Where are you? 506,000. I'm going to multiply by their percentages. So we get 219, 5. Is that 102, 950? What? Oh, and I never have enough room. That's 25,000. Okay, so I'm lifting up all the totals here and putting them onto my sheet of paper. And I'm going to multiply by what they have as their history, as their percent uncollectible. Right, so 2% is what they figure for that one, 4% for the folks that are 1 to 30 days, 10% for these folks, 15% for the accounts receivable that are 61 to 90 days past due, 35%, and 80. Okay. So just multiplying through, we get 10,120. And 20,000 here. Okay, so just multiply the estimated percent uncollectible by the totals in each of the category. And we're going to add them all up, and that will give me what the allowance balance should be. All right, so I get a total there of 67,210. That's what it should be. Okay. So when they ask for estimate the allowance for doubtful accounts, that's my estimate, 67,210. So the second requirement, assume that the allowance for doubtful accounts for Wiggs Plus Company has a negative balance already, 1,710, before adjustment on December 31st, 2010. Okay. So what are you? 17110. Illustrate the effect on the accounts and financial statements of the adjustment for uncollectible accounts. So we're going to do what we did just a few slides ago. We're going to compare what the balance should be. There's our estimate of what it should be. It should be actually minus 67,210. We currently have it at negative 1,710. So we're just going to subtract one from the other. Okay. So the required entry becomes 65,500. So what is the effect on the accounts and financial statements? It's at this point that we've got to come up with those columns again. We're going to make an entry. There we go. I think I'll put it here. So just like CNOW, this is very similar to your CNOW quiz. You're going to be given, your accounting equation, and then it's up to us to figure out, well, what's the required entry here? Yeah? Yeah, this is a contra account, and it's a negative type of asset account. So the balance is usually negative, right? So we want to take a look at what the balance should be. It should be negative 67,210. It's currently at negative 1,710. So we're just going to subtract that number from what it should be. So what we're actually going to do is add 1,710, right? And that means that our required entry is negative 65,500. Right. So we use the accounting equation, as we always do in this course. Under assets, how do we, what will be affected? Does anybody remember what account will be affected? Is it account receivable? The allowance account. Eventually, we'll get to accounts receivable. But it's that contra asset account, allowance for doubtful accounts. And we're going to give it an entry of negative 65,500. We're going to make it more negative. That's what we're going to do. What's the other part of the entry? Retained earnings, yes. We said retained earnings. Okay. And then somebody on this side said bad debt expense, and they're exactly it. So on the See Now quiz, you've got this little spot here on the bottom that says income statement, and it's up to you to find something that says bad debts expense, okay, and to put in 65.5. Does this have any effect on the cash flow statement? No. On See Now, you see this little thing here that says cash flow statement. Choose no effect. Okay. You're only going to actually put something on there if you have an entry here involving cash. Obviously, that's not cash. Okay, so we have illustrated the effects on the accounts and financial statements of the adjustment for uncollectible accounts. Good. So number 3, Wigs Plus Company reported credit sales $4 million during 2010. Assume that instead of using the analysis of the aging, what we just did, that they would like to use the percent of sales method. And they estimate that 1.75% of sales will be uncollectible. Illustrate the effect on the accounts and financial statements of the adjustment for uncollectible accounts using the percent of sales method. All right. This one's a lot easier, a lot less calculations, because we're simply going to do that. We're going to take a percentage of sales. And that number that we calculate, that becomes the entry. Okay. So on the other side, it'll be retained earnings minus 70,000. And it's the same as the previous one, right? So on the income statement, we got bad debts expense, 70,000. No effect on the cash flow statement. Okay. Right. So it might sort of prompt the question, which one do businesses use? Okay. Is it percentage of sales? What's the most popular? Or is it the aging? What do you think? If you're the accounting manager and you're told, okay, estimate uncollectible accounts, which method would you choose? Aging? Why would you choose aging?
It's more accurate.
More accurate. You're actually quantifying the risk here. You're putting some numbers saying, oh yeah, those deadbeats at 90 days, they're never going to pay, or the likelihood that they're not going to pay is higher. Yeah. But what's easier, of course, is percentage of sales, right? Just do it. Right? So what you often see, and what I do for one of the companies that I work with, that I use percentage of sales every month. At the end of the year, I'll do the aging. Okay, I'll be a little bit more precise. No, you just add to whatever balance is there. You only compare to the current balance and the aging. Here we're comparing what the balance should be compared to what the current balance is to come up with an entry. With percentage of sales, it's just add to it. So we're going to add 70,000 to the allowance account. Yeah, we don't reset it or anything or compare it to what the balance is. This just becomes the entry. It's as simple as that. Yeah. Okay. Okay, so assume that on February the 10th, 2011, Wigs Plus wrote off $3,500 accounts of the account of lasting images as uncollectible. Illustrate the effect on the accounts and financial statements of the write-off. Okay. So you want to write off $3,500. Does anybody remember how to do a write-off? We didn't. That was much earlier in the slides. Which accounts? Is there any accounts under assets that'll be affected here? Accounts receivable, exactly. And I am abbreviating it A/R, and that is fine if you want to do that on your midterm and final exam. Sure. Okay. So accounts receivable will go down. We're writing it off. We're saying we give up. They're never going to pay. But what do I have as the other part of the entry? The allowance. Yeah. This is where I get to use it. So it normally has a negative balance, and it's there for us to use as we write off accounts. So what I'm going to do is increase it, right? Not increase it. It's got a negative balance. So if I add $3,500 to it, it's got less of a negative balance that way. Right. Number 5. That same account. Lasting Images paid $3,500 on its account. So we wrote it off February the 10th, but on May the 17th, they actually pay. Well, that's good. Illustrate the effect on the accounts and financial statements of reinstating and collecting the Lasting Images account. So they're spelling it out for us here. They're saying there's 2 steps. First is to reinstate it, and then second, we're going to show the collection. Okay. So if we were to reinstate it, we do the opposite of what we just did. Okay. So we will add $3,500 to the accounts receivable account. Okay. And we'll put allowance for doubtful accounts back to where it was. Okay, that's the first step. And the second step is to show the collection. So I'll create a column here for cash. Cash goes up, accounts receivable goes down. That's accounts receivable. I don't know if you can tell that. Here's my column. Anyway, I don't have nice columns like you can see now, and I'm not using my spreadsheets again. All right, so cash is going up. This is accounts receivable. Let me make it obvious here. It's going down. Great. Any questions on this problem? Good. Great. So that's accounts receivable. All right. And so now we know what goes into recording that amount that we see on the balance sheet. You have to deduct some estimate for uncollectability. You can use the direct write-off method, but you're going to be violating the matching principle most likely. Why not try estimating an allowance for doubtful accounts in the same year of sale? Right? The other item that we're going to be taking a look at on the balance sheet today is inventories. Okay, so this pertains only to merchandisers or companies that buy something and then resell it. Okay, so they're going to have a certain amount of, quite a lot usually, of inventory on their books. Okay. So they've got a few dilemmas too about what cost do they actually capture to record that inventory, especially if the cost of what they're buying changes. Okay? So, you know, they're buying units of merchandise inventory here, and they might buy 1 unit at $19. And then next month they go to restock, and there's $21 is the new price. Next month after that, oh, it's gone up again. And then there's a bit of a decrease the following month. Okay. And then they have a quandary. Whenever they go to sell it, what cost do they use? Whenever they go to value that inventory too on the balance sheet, what cost do they use? Okay. So it's not just for cost of merchandise sold that they've got question marks actually. It's also on their, that's on the income statement. It's also on the balance sheet. Right? So what is the, what cost will they capture for their inventory account? Okay, so quandary, because there we go. Identical units are purchased at different unit costs, right? And when units are sold, it is necessary to determine the cost of that unit sold, the cost of the merchandise sold. So we need a cost flow assumption. Do we take the $19, the most recent, okay, the oldest rather, or do we take an average? Okay. At one time, we'd say, oh, just use the most recent. That was an option, but not anymore. 22. Okay, so yeah, we need a cost flow assumption. All right, so in Canada, these are the cost flow assumptions that we can use. Okay, and I know it's an American textbook. It presents you with one other. Ignore it. There's specific identification, which means you're going to record the cost of the merchandise sold using the cost of that specific inventory item. Okay? But you can imagine if you've got like tons of textbooks, okay, that you've bought various prices, and somebody buys a textbook in the university bookstore, to go back and track the cost of that actual one might be really difficult. Okay? So you don't want to do it where you've got hundreds or thousands of the same thing. All right? Most likely you'd use specific identification if it's really easy to identify. Oh yeah, it was that sports car, you know, or that diamond ring or whatever. The other more popular options here are weighted average cost. That's where you just take, and it is exactly that. It's a weighted average of all of the costs. Or another cost flow assumption, first in, first out. Okay, so going back, let me just go back. First in, first out says I'm going to start with the first costs that I've captured, and they'll be the first ones assigned to cost of goods of merchandise sold. Okay, and then after I've done costing all of the $19 units out, then I'm going to go to the $21 units. Okay, and then I'll assign those to the cost of merchandise sold account. Okay. What it also means is that the most recent costs, the $23 and the $22, they stay in inventory. So what does specific unit cost? You're going to identify the cost of the specific item of the inventory that you sell. So example, a jewelry store has 5 diamond rings. Okay? They usually don't have a lot. You know, they're not going to have thousands of the very same diamond ring. They're going to have just a few of each, right? And some of them are really small, and some of them are huge diamond rings, right? So they actually are able to identify the cost. The smaller ones, $1,000, $1,500. The bigger ones, $2,500, $4,000, $10,000 that it costs them for the diamond ring. So and it can specifically identify, okay, the cost of the diamond ring. So one day they sell that diamond ring that costs $10,000 for the $15,000. They're able to specifically do that. And it's much easier if you've got some sort of unique identification number, you know, some sort of like vehicle identification number for an automobile, or maybe using SKUs that are specific, okay, to that particular unit. Okay. Most likely, though, you're going to have a business that uses weighted average or first in, first out, or FIFO. We call it FIFO, by the way. Right? So let me take we're going to go through the costing for those last 2 inventory cost flow assumptions using this data. So October the 12th, this company buys 10 widgets at $19. So their purchase there is $190. The next day they sell 5. The next day they buy 20 widgets at $22. The next day they sell 20. Okay, so we're going to use this data to illustrate FIFO and weighted average. Okay? So at the end of the day, they've got 5 widgets, right? All the purchases less all the sales. So what FIFO means is that the first costs that came into the account are the first ones assigned to the cost of merchandise sold. Okay? So I bought on October the 12th 10 at $19. Okay? Whenever I go to sell my widgets the next day, I'm going to use the first cost that came in. So I only have one set of costs. They're at $19. So I'm going to use that. Okay? So that leaves 5 widgets at $19 remaining, right? The next day I buy 20 widgets for $22. Okay? So right now my ending inventory balance, I still have the 5 at 19, okay, from the first purchase. And now I'm adding now 20 units at $22. Okay, so my inventory account's got $535 at that day. So the next day when I go to sell 20, FIFO says, use the first costs in. Use these first. Okay? I sold 20. I must first go to the oldest costs that are in the inventory account. So the $19 widgets. Those will be the first costs that I'll assign to cost of merchandise sold. Okay? But I don't have enough, right? I sold 20. I've got cost for 5. I still need cost for 15. Okay? So I'll go to the next purchase. I had 20, okay, but I'm only going to use 15 of them. All right? So in that calculating the cost of the merchandise sold on that particular sale, I start with the 5 at 19, and then I'll use 15 of the following purchase. Okay, 15 of $22. So in total, $425 will be the cost that I'll assign to cost of merchandise sold. Okay? First cost in, first cost out to the income statement, to cost of merchandise sold. So what do I report on my income statement? In total for the month, $520. That is that sale and that sale. It gives me $520. For merchandise inventory on the balance sheet, well, at this point, all I have left are the 5 at 22. Okay, so they will be what is my most recent costs, are the ones that I use as inventory. Some people say, that's a great cost flow assumption. Does it have to match the physical flow of inventory? And the answer is no. Okay, yes, especially in the grocery store, you'd want to sell, those older ones first, right? So you're always sort of maintaining freshness and nothing goes bad on the shelf. It does not have to match the physical flow. Okay, we're just talking about a cost flow assumption. Right? It's not to say that that's physically what's happening. Although I have to say that's probably a good merchandise management, tool, is to sell your oldest stuff first. Right? How do we do weighted average? Well, we're going to take not just a plain average of all of those inventory purchases, but we're going to take a weighted average. So if we bought more widgets at $19, it's going to have a bigger weighting. Right? So in order to calculate the average unit cost, I'm going to take the cost of the goods that were available for sale throughout the month, and that'll be my beginning inventory plus all of my purchases. Okay? So if I go back to my data, I'm just backing up here. Take of all the costs of the inventory that was available during the month. Well, it's these two purchases. I didn't have a beginning inventory. Okay? So what is that? 630. There we go. So that's my total cost of goods available for the month. Beginning inventory plus purchases. Had no beginning inventory, so I'm just adding purchases here. And I'll divide it by the total widgets, or the units that were available throughout the month. So beginning inventory plus purchases there. Well, I only had 30. Okay. So on the numerator here, purchases in October, and I bought 30. Right, so 630 divided by 30, I hope is 21. That's an old slide. I still hope it applies. And I'm going to use that $21 for each unit in my costing of my cost of merchandise sold, or my cost of goods sold, and my ending inventory. So if somebody said, oh, I sold 25 widgets this month, that's what I'm going to use, $21, to cost out those 25 widgets. Okay, if somebody said, there's only 5 units on hand at the end of the month, I'm going to use $21. Right? So it's got a bit of an extra component of, you have to add more and divide more. So there's my purchases. There we go. How do you choose? All right. You might want to choose the one that has the highest cost of goods sold, because that way you'll be decreasing net income, and your income tax will be less. Okay, so yeah, you could do that. The Canada Revenue Agency says that FIFO and weighted average are fine. You used to have a little caveat in there. You can't use LIFO, but now LIFO isn't even allowed for accounting purposes, so we're good. You might want to choose a method that corresponds to the physical flow, though that's not necessary. Okay? You don't necessarily have to match the physical flow. You might want to report an inventory cost on the balance sheet that is close to the inventory's recent cost. You might want to. You have a lot of assets. And you might want to use the same method for all inventories having a similar nature and usage in the company. But you don't have to. All right. Okay, so we'll do an exercise from the textbook. Units of an item available for sale during the year were as follows. Okay, so they have a beginning inventory. And throughout the year, February 17th, July 21st, November 23rd, they purchase a whole lot of inventory. And you can see the price keeps changing, right? 120, 138, 156. Seems to be a period of quite a lot of inflation here. Right? So there are 50 units of the item in the physical inventory at December 31st. They use the periodic inventory system. Determine the cost by A, the first in, first out method. That's called FIFO. I crossed out B, only because we don't use this in Canada, all right? Not allowed since, when was it, July the 1st, 2007, 2006? It's been a while. And C, the average cost method. Okay. What is it here? A. FIFO. Okay, so what is the inventory cost? You know, there's really two things that can be asked in these sorts of problems. What is the cost of the merchandise sold, and what is the inventory cost, okay, on December the 31st? So we do know that there are 50 units left. Okay. So they must have sold quite a lot then, eh? Let me just figure this out. That in total is 180 units. Okay, so throughout the year, they started with 27. They bought additional units. They had 180 available for sale at one point, some point, throughout the year. Okay, there are 50 left, so they must have sold 130 units, right? Everybody still with me? Got 180 throughout the year. Got 50 left. You must have sold 130. All right. So what costs are still in inventory? That's what we're being asked here. Determine the inventory cost by A, the first in, first out method. So what remains in inventory? Let's do it this way. Is it these units at 165, or is it these units at 120? 165, right? Because first in, first out said that these were assigned first to the cost of merchandise sold. Okay. Let me write it out so that you understand what it is. These costs first were assigned to cost of merchandise sold. So their first sale of 27 units, we would have used the $120 costs. The next sale, up to 54 units, they would have used 138. Okay, so all of these costs were assigned to cost of merchandise sold. It's whatever is left, okay, remains in inventory, and that's what we were being asked. Determine the inventory cost. So if I've got 50 units, it's the last units that I'm going to start with, because they're the ones remaining in inventory. The other unit costs have been assigned to cost of merchandise sold. Is it 36? Oh, yeah. Sorry. But I don't have enough. I've only costed units to 36 units, right? So I need how many more? 14, yeah. I'm trying to get up to 50. Let's see. I need cost for 50 units. I've got cost only for 36, so I need cost for 14. So then I go to the other, I'm starting here. So I've used all of the 36. I'm going to use some of the purchase then from July 21st. I had 63 units at 156. There we go. So there's the cost of the inventory December the 31st, $8,124. Okay. All right, we're not going to do B, last in, first out. Forget about it. C, the average cost method. Okay. Yeah? The January 1st inventory, those costs are the first ones assigned to cost of merchandise sold. We're being asked what is the cost of the inventory, so what's left. So we're starting at the bottom. Does that answer your question? Yeah. What's not being asked here is what is the cost of the merchandise sold, which would actually sort of complete the picture. That's when we can actually say, oh yeah, first in, first out. It's first in is what is assigned to cost of merchandise sold first. Okay, so we had 180 units. Okay, we've got 50 left. We must have sold 130. So if we were to assign cost to 130, we'd start with the opening inventory first. Okay. So I'd start with the opening inventory. So was it 120? Yeah. And then I'd keep going until I reach 130. I've got 54, 138. Good. I'm going to have part of that 63. Anyway, let me just multiply through here. All right. So how many do I have here? That's important to know. I'm at 81. Okay. So I've got costs now for 81. If you can see that. I'm trying to get to the 130 that I sold. So I need 49. So I'm only going to use, of that July 21st purchase, I'm only going to use 49 of them. Yeah. And this is the February 17th purchase. So what hasn't been, let me go back. So cost of merchandise sold equals 18,336. Okay? Because the first costs that are in the accounting records are the first ones assigned to cost of merchandise sold. Whatever hasn't been assigned to cost of merchandise sold is what remains in inventory. And that's the question that they're asking us. And it's a bit convoluted. So what we didn't cost out to cost of merchandise sold is 36 units at 165, 14 units at 156. Okay? Because that's what's being asked. What is the inventory cost? Okay. If they were asking us what is the cost of the merchandise sold, then we'd start with the first costs in, because they'd be the first ones out. Okay. Does that make it more clear? Yeah, so I'm starting with the older unit costs, right? So I started here, but there was only 36 of them. I need cost for 50, so I'm going to work backwards. So I looked at that previous purchase of 63 units. I only need 14, but I will use the other costs are 156. Okay. We know how to calculate cost of goods sold, right? Beginning inventory plus purchases less ending inventory. Yeah, that's what you've done there. Yeah. All right. So it's all clear then? Any questions? All right. So that's FIFO, first in, first out. We're not doing B. The next method that we've got to use is average cost method. Okay, so what we have to do here is come up with one average cost for the entire year. And we're going to use that average cost and use it to assign and calculate the cost of the merchandise sold and the inventory. Available for sale. All right, so in order to calculate the average cost, there was a formula that we could use. I'm going to take the cost of the goods available for sale. So that's the cost of the inventory plus the cost of all the purchases throughout the month. Okay, and divide it by the units that were ever available throughout the month. All right. I was going to do it on the slide, but it's already mixed up. Cost of goods available for sale. It's the cost of the beginning inventory. So there's 27 at 120. And then we had another purchase, 54 at $138. And then we had another purchase, 63 at 156. And then we had our last purchase in November, 36, 165. Okay. Cost of goods available for sale is beginning inventory plus purchases. Okay. So multiply through all of your purchases, divided by the number of units that were ever available throughout the year. So we started with 27. We added 54, and then 63, and then 36. Okay, I'm getting 26,460 on the top. Yeah. And then on the bottom, 180. Oh, it's a nice even number. $147 a unit. Okay. So when we say weighted average, we don't mean just an average. That would be really nice, but it's not. So we're not just going to take an average of 120, 130, 156, 165, like all of these costs here. We're going to weight it. So if we bought more units at 63, more units at 156, which we did here, we're going to give that a bigger weighting. Okay? And the way we do that is just by multiplying through, right? So that's what I've done here, just multiplied through. Gave it a bit bigger weighting. Okay, so I get 147. Okay, it's not a simple average, it's a weighted average. Okay. So, what the average cost method says is, now that you've got that, multiply through by the number of units you're trying to cost, which in this case is ending inventory. I've got 50 units on hand at the end of the year. I'm going to use that average cost, okay, and calculating it out. Okay, so that's 73.50. Right? Which one gave us more? So that was weighted average gave us an answer 73.50. FIFO gave us 8,124. Why did FIFO give us a bigger number? This is FIFO. Why do we have a larger ending inventory with FIFO than weighted average? Yeah, time of inflation, the most recent prices are the largest, whereas with weighted average, it was taking a little bit of everything, eh? Yeah. Yeah?
As a business, why would you want to use
Yeah, just a preference.
in terms of dollars?
Or maybe you want a little bit of income smoothing, because that's what's going to happen. So you don't want... You're going to have a higher cost of goods sold, because you will be taking, so maybe for tax purposes. Yeah. Or you want to be, more conservative with your cost of merchandise sold, you might want to use FIFO. Right. Okay. The last topic in inventory has to do with writing down your inventory. Okay. And so in the book, they call it valuation at lower of cost and market. And I know that the American term is market, but in Canada, we've actually got another word for it. We call it net realizable value. Okay, because it's not really market, it's net realizable value, which means if you were to sell it today, how much would you get for it? But we're going to subtract out some liquidation costs. Okay, so anybody to help you sell that inventory. So that's why my slide is referring to more the Canadian method here. So what is net realizable value? Selling price less any costs required to make the goods ready for sale, like your liquidation costs or whatever. Right? So what we're going to do is to just compare that all the time, the cost of your inventory, and we'll probably do this in large classes, right? So, if you're in Loblaws, you might compare your groceries compared to your pharmacy items, compared to your, they've got everything at Loblaws superstores or whatnot. So you're going to do this on large classes of inventory. So look at the cost of that inventory, determine the net realizable value of that, and then use the lower value to report inventory on the financial statements. Okay? Because if you can imagine, you know, you've got some really old inventory on the shelves that is, you're not going to sell it for more than what you bought it for. Okay? So let me give you a little history lesson. A long time ago, if I was to be using a computer and I wanted to save a document, I'd save it on a floppy about this size. Okay. Does anybody remember that? And prior to that, I'd save it on a floppy that was even bigger, and it was floppier too. Does anybody remember that? They were, what are they, 5 1/4 inches? They were really floppy too. And you couldn't put pen on them, and you had to be really careful. Anyway, so the floppies used to be small, like this, and then even before that time, they were larger and floppier. And even before that, they were, I remember, some were like the size of this page, right? So let's say you're a computer retailer, and you've got a whole lot of DOS 3.1 on these floppy disks. Does anybody remember that? Does anybody know what DOS means? Yeah? Okay. It's a disk operating system. That's right. So let's say you had a whole lot of those floppies on your shelves. Okay? You're not going to get anything for it, right? Because that's not how we sell operating systems anymore, right? We've got, anyway, other ways of downloading operating systems onto your computer, and on a floppy disk is not the way anymore. Okay, so this is where we have this rule of lower of cost and net realizable value. Okay, you might have bought that floppy for DOS 3.1, you know, at a few $100s back in 1985, but you're not going to get it that much, all right? So if you've got an inventory that's worthless or essentially worthless or has taken a hit in value, okay, or in selling price, market value, for whatever reason, you have to record it the loss of cost and net realizable value. And that's only because accountants, we're very conservative. We don't want to overstate our assets, okay? We really don't. Okay? So there's an example. Let's say you've got some broad classes of inventory, scarves, hats, mittens, and you took a look, you compared your cost to your, this is net realizable value, by the way. So you took a look at your scarves and you said, yeah, they cost me $10,000, but I'll still be able to sell them at $11,000. That's in a good position to be. You're going to value them at $10,000. But let's say the hats you bought, okay, you bought them at $20,000, but they're so last year, and you're only going to get $17,000 for them. You should record it at the net realizable value, in that case of 17. And the mittens, you bought them at 8. You could probably sell them and have a net realizable value of 9,000. Again, I'm going to use the lower of cost or market here. Okay, so when I take a look at these broad classes of inventory, I get that although my cost is $38,000, I should really be valuing it on my balance sheet at $35,000, this number here. Okay, so I must reduce inventory by $3,000. Okay, all right, and that will also reduce retained earnings. All right, so actually, I was looking at Loblaw companies. Okay, because they are a big merchandiser. I know this is really small. This is from their annual report. Maybe I could probably make this bigger. Thank you, Jill. All right. So it says here inventories. I don't know if you can read that, but it says the company values merchandise inventories at the lower of cost and net realizable value. Okay, so Loblaw Companies is Canadian. They're using the Canadian comparison here. Costs include the cost of purchase, net vendor allowances. Okay, remember we talked about purchase allowances, and if we were to return merchandise or buy merchandise and we'd get an allowance off of the cost, this is what they're saying. They record their inventory less or net of vendor allowances, plus other costs such as transportation. Remember, I think it was last week, we were looking at the cost of transportation, freight in. If we're obligated to pay it, we will add it to the inventory. And that's what Loblaw is doing. Okay, this is a note to their financial statements. So transportation that are directly incurred to bring inventories to their present location and condition. Seasonal general merchandise and inventories at the distribution centers are measured at weighted average cost. So again, we've got this cost flow assumption that we were just talking about. Well, that's what Loblaw Companies uses. Okay. The company estimates net realizable value as the amount that inventories are expected to be sold, taking into consideration fluctuations in retail prices due to seasonality, less estimated costs necessary to make the sale. So it's feeding directly into our definition here, okay? And it's exactly what Loblaw Companies does. Inventories are written down to net realizable value when the cost of inventories is estimated to be unrecoverable due to obsolescence, damage, or declining selling prices. Okay, so this is just their policy, their inventory policy.
Work somewhere that
You were that buying it yourself and the cost. That's what they are using it. So yeah, that's what Loblaw's company will do. They've got seasonal merchandise at all sorts of costs, and they're taking a weighted average cost to put it onto their balance sheet. Okay, less any vendor allowances, plus any transportation, right? So they're saying exactly what costs go into that line. Okay. Yeah, they're going to mark it up and sell. Yeah, that's sales. Yeah. And that's how you make money, right? Okay. So here's Loblaw's company, their balance sheet, okay? And so we see these amounts for accounts receivable and for inventories, and we know exactly how they've recorded their inventories. What's gone on to preparing that number? That's $2,112 million of inventory that Loblaw's holds. This is their accounting policy. They also have a policy for receivables. Okay, so I don't know if you can see that here either, but they've got credit card receivables through President's Choice Bank. Okay, so they've got their own little bank, President's Choice PC Bank, and they've got credit card receivables are stated net of an allowance for credit losses. That's just what we were talking about, the allowance for doubtful accounts. They're calling it something a little bit different. Yeah, any credit card receivable with a payment that is contractually 180 days in arrears or where the likelihood of collection is considered remote is written off. Interest income on credit card receivables recorded on an accrual basis. Anyway, we're not going to get into that. But that is what's gone into recording each of these lines. Okay, that's their policy behind it. And that is the end of Chapter 6. So next week, before you leave, I will be taking up Chapter 7. It's basically now a chapter, right, every week. And I know I haven't been writing it down, but if you could do a few of the problems, right? So read the chapter and do these problems because we're going to take them up in class, right? And so if you can just attempt it, you come to class just that little bit more prepared, right? And try to stay up on all of this. It's really important, you know, that you understand one concept before moving on to another. Okay? This is a lot like building blocks. Right? So good luck with the quiz. You should be well prepared. We've covered very, very similar problems in class today that you'll see on your See Now quiz. Okay, have a good week.